All right, let's get right into it. We're talking about something that's, well, quietly rewiring the entire global economy, and that's artificial intelligence. It's not just some tech buzzword anymore. This is a real, powerful force, and it's changing everything about finance, from the big dogs on Wall Street all the way down to, our own retirement accounts.
But look, to really get a grip on where we are now, we've got to go back a bit. And I want to kick things off with a pretty wild question. What happens when just one algorithm, one piece of code, can crash the entire stock market? I know, sounds like something out of a sci-fi movie, right? Well, it's not. It actually happened.
Okay, picture this. The date, May 6th, 2010. It's just a regular Thursday on the trading floor. Yeah, the market's a little jumpy, but nobody, and I mean nobody, saw what was coming next. All of a sudden, the market just tanks. We're talking a nearly 10% nosedive in the Dow. Trillions with a T, trillions of dollars in value just poof, gone. The panic was real. Was this another massive financial crisis?
But here's the craziest part. The thing that's really going to blow your mind. This whole collapse didn't unfold over weeks or days. No, it happened in minutes. A catastrophic freefall at a speed that is just inhuman, impossible for anyone to even process, let alone react to.
So, what caused it? Here's the kicker. What everyone now calls the flash crash. It wasn't triggered by some huge geopolitical event or a terrible piece of economic news. Nope. The culprit, as investigators later figured out, was just a single big sell order from a mutual fund that was triggered by an algorithm. That one little bot started a domino effect, this crazy chain reaction, causing thousands of other high-frequency trading bots to just follow the leader and sell, sell, sell. It was like a ghost in the machine took over.
And remember, that was back in 2010. The algorithms then were, relatively simple compared to what we have now. So let's fast forward to today, because now, oh man, AI isn't just playing on the sidelines anymore. It is the main event. We're talking about systems that are chugging through massive, massive data sets in real time. They're the engine behind the majority of trades. And the big thing is, they operate without human emotion, without bias. They just make cold, hard, calculated decisions.
So yeah, this isn't some sci-fi what-if scenario. This is happening right now. AI is basically the new financial brain, working 24/7, analyzing everything and managing trillions of dollars.
And just look at how deep this goes. These are the new market movers. You've got absolute giants like BlackRock's Aladdin, which is this incredible system that manages risk for huge pension funds. We're talking about your retirement money. Then you have things like TradeRiser, which is wild. It scans all of social media, all the news, just to figure out investor sentiment, the vibe around a stock. And it's not just for the big guys. Platforms like CopyTrader let regular folks like you and me literally mirror the trades of top performers automatically. And of course, you've probably heard of robo-advisors like Betterment or Wealthfront, right? They're giving millions of people access to low-cost automated financial advice.
What's so cool about this is that it shows your AI in finance isn't just one single thing. It's a whole layered system. See, up at the top, you've got all the different markets, stocks, crypto, you name it. Then you move down a level to the how, the different ways to analyze them, like fundamental versus technical. But the really juicy part is down at the bottom. Those are the actual AI engines, deep learning, reinforcement learning, all these different techniques being used in every single type of market you can imagine. It's a whole ecosystem.
And all of this, as you can probably guess, brings us to a huge debate. A central question, really. Is all this AI making our markets more efficient, or is it just introducing a new, much scarier kind of chaos?
And here it is, laid out plain and simple. On the one hand, you've got the promise. Incredible market efficiency. AI can digest news instantly, right? That means faster price discovery, more liquidity in the market. It cuts costs and makes sophisticated tools available to more people. That's the dream. But then, there's the peril. What happens if all these AIs, all these brilliant machines, start thinking the same way? You get this digital groupthink, which could lead to flash crashes that make 2010 look like a warm-up. You might see a market that's just permanently more volatile. And it opens up brand new ways for bad actors to commit fraud or manipulate things. Plus, a lot of these AIs are black boxes. We don't always know why they make a decision. So when it goes wrong, who's to blame?
And that argument for efficiency, it's really strong. I mean, look at this research from IRE journals. They're basically saying that because AI can absorb information so much faster than a human ever could, it helps market prices become more accurate, more quickly. The theory is that makes for a more stable, fair market for everybody.
But, and this is a big but, here's the scary flip side. Imagine you have thousands of super powerful AIs. They're all trained on similar data, they're all using similar models. What happens when a piece of news hits? They could all react in the exact same way, at the exact same nanosecond. That's not efficiency, that's a digital stampede. It's basically a recipe for chaos, for volatility like we've never seen before.
So this whole debate, efficiency versus chaos, it naturally leads to a really interesting question, a very human question. In a world run by these super fast machines, what happens to the old ways of doing things? What happens to classic investment strategies like value investing?
So just so we're all on the same page, what's value investing? It's the old school strategy of buying stocks that look cheap compared to what they're actually fundamentally worth, based on their earnings, their assets, that kind of stuff. Think of it like bargain hunting. You're trying to find a dollar bill that's on sale for 50 cents.
And this table is a perfect way to see how that works in practice. Let's say you're a value investor back in 2019, and you're looking at Starbucks versus Chipotle. You'd see that a huge chunk of Chipotle's stock price was pure speculation. It was based on big hopes for future growth, aggressive expansion plans that hadn't happened yet. Starbucks, on the other hand, a lot more of its price was anchored in stuff that was real, right now, its book value, its current earnings. The value investor avoids that big speculative risk. They want the company where the value is tangible, right here, right now.
Okay, but here's the multi-trillion-dollar question. Can that patient, human-driven approach actually compete with the machines? Well, let me just throw a number at you. 600%. What on earth could that be?
Well, a study out of Stanford found that's the performance improvement of an AI analyst over your average human mutual fund manager over a 30-year span. Think about that. The AI, just using publicly available data that anyone can access, generated almost 600% more alpha. That's the Wall Street term for beating the market. It was simply finding patterns in free data that humans were completely missing.
I mean, that's just a total game changer, right? And it really makes you wonder, if AI is already this good, what's next? Where is this all going? What does the next generation of AI traders even look like?
This chart really tells the story. The amount of money and brain power being poured into this field isn't just growing, it's exploding. Look at those blue bars. That's the number of research papers on AI in finance. That curve is going almost vertical. We are right on the edge of a massive, massive transformation. And some of the ideas being worked on right now are straight out of science fiction. For example, something called the Darwin-Gödel machine. This is an AI that can literally rewrite its own programming. It tries something, fails, and then it modifies its own code to do better next time, all by itself.
Or what about this? Continuous thought machines. This is a totally new way of building an AI. It's not just about processing data anymore. It's about the timing and the rhythm of its own internal signals, treating that as part of how it actually thinks. It's an attempt to build a much more fluid, almost intuitive kind of intelligence.
And that's where we'll leave it. It really puts things in perspective, doesn't it? The AIs that caused the flash crash, they were basically simple calculators compared to what we have today. The AIs we have now are already outperforming the vast majority of human experts. And the AIs of tomorrow, well, they're being designed to teach themselves, to evolve, all without us. So as these systems learn to trade and evolve and improve on their own, it really leaves us with one final big question. What's the role for the rest of us?